If you're looking to invest and are applying for a traditional mortgage, you're getting outdated advice. Non-QM loans have become the go-to strategy for serious investors who want to scale, move fast, and stop letting old requirements hold them back. If you're still relying on conventional loans for investment properties, you're likely limiting your growth and leaving deals and profit and real estate riches on the table. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in working with investors for non-QM, for DSCR loans, getting them funds quick to live the real estate riches dream. So I recently worked with an investor who actually had 5 investment properties and was looking to buy another. And no, he didn't come to me first. He actually did what most people do, walked into the big bank where all his money was. And what they did was they actually looked at his tax returns and said, hey, buddy, let me take a peek at your 2024 tax returns. So they took a look at it. They saw all the corporations and all the investment properties and the way that a conventional mortgage, how they calculate and figure out if you qualify, is super antiquated, and it just didn't work. He had all sorts of expenses, and just like the numbers didn't work per the actual guidelines to qualify for a conventional loan. So he actually saw our team on social media. He reached out to me and said, hey, I'm trying to buy my 6th investment property, but typically I have no problems. And I guess for whatever it was that year, maybe some of the expenses that were written off were a little bit too high. I'm just not qualifying for this property, but it's a sweetheart deal. I'm putting 25% down. It cash flows, meaning the rent covers the mortgage. It should be no big deal, but I'm struggling, and I really want to buy it, Andrew. Please help out your bro. So it wasn't my bro yet. So we took a peek, and they were absolutely correct on the tax returns. The accountant was a little aggressive with the write-offs, a lot of expenses, and he just didn't qualify. So here comes a DSCR loan. It actually turned out to be the easiest, that's right, the easiest mortgage I've probably ever done in my career. Why? Because number one, he was putting down 25%, which is a great number for a DSCR mortgage. Typically, you can get away with 15% down. I would say don't do that because the rate starts becoming super spicy. 20% down or more is the sweet spot. 25% down on a DSCR mortgage, a debt service coverage ratio mortgage, the non-QM investment loan that'll help you all accomplish your dreams. The 25% down number is phenomenal, so he's able to do that. Number two, the actual mortgage payment versus the rent. The rent was phenomenal, sky high, especially in New York. A lot of investors struggle having that rent kind of meet the mortgage payment, which we'll talk about later. There's still some options. But with that said, the rent exceeded it by far. It was actually almost 50%, an extra 50% cushion. So for instance, if the payment was $4,000, I believe the rent was like $6,000 just on the property. So he was just applying for the wrong mortgage. He didn't somehow, maybe living under a rock at the time at least, he didn't know about a DSCR mortgage. So we put him in the right mortgage, 25% down. He wasn't in contract yet, but it was a fast close required to get an accepted offer. We talked to the listing agent, told him how quick we can close, and from contract to close, it was a 2 to 3 week process. It was awesome, but it just shows you sometimes investors, they just don't know what's out there. But of course, I hear you saying, hey, Andrew, I'm sure the rate was horrific. You probably gave him some predatory rate. No, believe it or not, DSCR mortgages, the interest rate actually could be better than a conventional mortgage. Now, sometimes these loans have prepayment penalties. Now, what is a prepayment penalty? It's not something that's predatory. It's if you pay your mortgage off within a year, 2, 3, 4, 5 years. There's a small penalty, but you're able to do it, and we'll talk about that in a little bit. But also, the typical commentary is always, hey, Andrew, these loans are not offered by anybody. Almost nobody offers them. No, that's not the case. Sure, you can't walk off the street and walk into your local bank and get one. These are not as popular on the retail bank side. Why? Don't ask me, but non-QM is taking the world by storm. DSCR mortgage, investment mortgage is part of the non-QM mortgage suite, and they're super popular. You just have to typically go to a mortgage broker company who has access to wholesale lenders that offer this, and that's where you're gonna find the loans. You gotta come to guys like me to get these types of mortgages, people that specialize in these types of mortgages. And of course, the good old, hey, Andrew, these mortgages are going to contribute to another crash, right? Wrong. So just remember, guys, to me, the crash, you had very little money being put down. Now, DSCR is typically 20, 25%, maybe even more. So you have equity, number one, right? Equity's there. You're not walking into a purchase with no equity, where psychologically you may walk away from, that type of mortgage if the market goes sideways because you're not keeping any equity. You're not walking away from any equity by doing that. So there is more equity because people putting more money down. The loan to values are less. The equity positions are higher. It's very atypical versus the crash. So now the new norm is one reason why the crash won't happen again. And the second piece is these are typically 30-year fixed vanilla mortgages. They're not adjustables. They're not more exotic. So the terms are great. So whatever that payment is, besides the tax and insurance changing just a little bit, they're always going to stay the same. And of course, outside of that, those are the reasons in the crash where you had no equity, you had all these adjustables. The adjustables come due, meaning now they are adjusting to the current market. Maybe the rate goes up, maybe the person can't afford it. So a 30-year fixed vanilla mortgage plus a high down payment, these are the reasons why these loans are going to be here to stay, because if the rent covers the mortgage, typically the mortgages, and the clients that are getting them are always paying on time. And Wall Street, the secondary market, loves it. No crashes are coming. Non-QM loans have taken the world by storm. And there's a bunch that kind of fall under the non-QM suite. We're going to go over all of them. But the one we're going to focus on today is going to be the DSCR mortgage, the one specifically geared towards investors. Why is it all the T? Why is this guy Andrew? Why won't he stop talking about it? Because it's allowing investors to increase the real estate portfolio. It's a super easy loan, but of course, maybe you don't know what it's all about. So I'm going to show you exactly what it is, why it's so easy to qualify, and why the other typical mortgages, conventional mortgages, why they just don't work. So if we start with non-QM, right? So what the heck is non-QM, right? Non-qualified mortgage. I had to give you a taste of my handwriting. What does that even mean? So typically you have FHA, you have VA, you have conventional mortgages, right? Which is Fannie, you have Freddie, all these names. You have USDA, you have portfolio loans, you have jumbo, all this type of stuff. So non-QM was basically a mortgage created that is not in all of these, let's call these vanilla loans in the box. So FHA, VA are for primary, not for investment, wouldn't work for our DSCR loans. Conventional, we'll talk about in a second, USDA, portfolio, jumbo, there's all these different types of loans. But when it comes to investment programs, believe it or not, a conventional mortgage, which is what we'll follow kind of the process on right now. If we look at a conventional mortgage, when you do an investment, sometimes they cap you on the amount of properties you can get. So if you have an investor, like in our case, they were up to the 6th property, there is no cap. So the DSCR, a big plus here is I know the kids say no cap, but there is no cap on the amount of mortgages you can get as long as you qualify, obviously. So on the conventional side, we're going to look at tax returns, where on the DSCR, there are no tax returns, right? So this is why a conventional mortgage typically doesn't work. An investor like the one that I helped out, who walk into a big bank, they'll look at his tax returns, say the year is 2024, right? And in 2024, maybe he bought all these properties, or at least a bunch that he owned. I think he owned about 5, as we said. And these properties that he owned, maybe there were a lot of expenses when he first bought them, maybe some rehabilitation work, things like that, so he was showing a loss. If you think of a tax return, if you think of a Schedule E, you figure there's rent, there's expenses, and then there's net profit. So that net profit was negative because, say the rent was, $48,000. Maybe the expenses could have been, $80,000. So that would show a $32,000 loss. So that means when you qualify based off of the income in the ways that a conventional mortgage does, he's not going to qualify, let alone doing that times 5 properties, just not going to qualify. So this is a reason why the DSCR mortgage is the one that holds up most. Because we're not going to look at any tax returns. We're just going to look at the market rent on the specific property. And if the guy owns another 5 properties, as long as he's making the mortgage payment on time, his credit profile is good, none of that other stuff matters. So outside of that, you say non-QM, you talk about a product suite. So there are other loan types with non-QM. There's, especially for primary, secondary purchase, there's bank statement programs, which they're super popular for. So a bank statement program is when you typically give 12 or 24 months of the bank statements. We look at all the revenue, and then that's what we're going to gear the income versus the tax returns. That's what we're going to use for income. They're very popular, not typically for investments. Outside of the bank statement program, there's a 1099 program. The 1099 program is if you're a 1099 contractor versus a W-2 employee, 1099, all that means is you're self-employed. So instead of looking at a Schedule C or potentially an S-Corp return, we're actually going to look at, again, just the 1099s. So say in 2024, they made 150K. 2023, they made another 150K. We can use up to 90% of that instead of having to look at tax returns. So it's just another cool option. There's something called asset depletion or even asset dissipation, all these cool words. It just means if you have money in the bank, let's say the person has $1 million post-closing liquidity in a retirement. Of that retirement, if we divide it by 60, that net number, we can add that for income. So $1 million divided by 60 is 16. Let's call it 667. So why is this cool? Because maybe this person doesn't show much income, but $1 million dissipated turns into $16,000 a month of income. And it's just a guideline. It's just a cool program. So these are some of the cool ones. But on the DSCR side, I'm going to show you how it works and why it was so cool for this investor. So the investor was buying a $1 million sale price house. It was a 2-family. Taxes on it were $15,000 for the year. Insurance was $4,800 for the year. All right. Now there's 2 units, right? So let's say unit 1 and unit 2. So each of these units got somewhere in the amount of, I believe, $4,000 a month in rent, if my memory serves me right. So $4,000, if you add it all together, that's $8,000 a month. So as long as this mortgage, and there's other options too, if it doesn't cover, but ideally, perfect world, you want the mortgage to be $8,000 or less. Because on a DSCR loan, which is what we're talking about, to qualify, typically it's put about 20% down or more. You need 680, 700 credit or better. You could be a first-time investor. It gets a little bit tough. But ideally, you're a continual investor, 20% down or more, and the market rent covers the mortgage, and that's it. Voila, you qualify. So on this, don't let me down, Sharpie. On this $1 million sale price, he was putting down 20%. So that was an $800,000 mortgage. Actually, I believe he put down 25%, which made it even better. So let's pump this up. Right? So 25% of that, it was a $750 mortgage. Right? So a $750 mortgage, the rate was around 7%, 7.5% APR. So you figure, I'll make this prettier for you guys. A $750 mortgage was like something like a $5,300-ish mortgage payment, just to be super rough. So $5,300 a month mortgage payment, just making it real simple for you guys. If you add to that the $1,250 for taxes, and you add another $400 for insurance, that came out to what? $6,550, $6,950. There you go. So again, and that's why, if you remember, I said he should have got a loan all day long, putting 25% down on an investment. It's amazing. So you have $1 million as sale price, 25% down, a $750 mortgage amount. And then from there, just roughly about a $5,300 mortgage payment, just to keep it simple for numbers, just to give you a good illustration. $1,250 a month for taxes, $400 for insurance. So that's a $6,950 payment. Now, that $6,950 is less than $8,000. It qualifies. But you say, hey, Andrew, what happens if the rent is only $6,000, but the mortgage payment is $6,950? That's actually a great question. So there are options. So say the market rate right now in a DSCR is 7%. So there's programs where, as long as the rent covers about 3/4 to a little less than, fully covering the payment. So in this case, 3/4 of that is what? Like the low 5,000 range, somewhere around there. So since the rent is over 75% of that mortgage payment, follow me, but it's not full, it's not $6,950. So you'd say like, hey, Andrew, I thought you said DSCR has to cover the actual payment in full. It actually doesn't. There's another bucket that some lenders allow, and that's when you work with a broker company. They get you on with the lenders that have all these liberal guidelines. Again, the second piece is, as long as the rent in, option number 2, it covers most of the mortgage, which it does. it covers something like, you know, a little higher than 80 to 90%. So all that means is there's going to be a little bit of a cost add on to that rate. Maybe that rate of 7% goes to 7.5%. So then your payment could end up a little higher. You know, maybe it goes up to, I don't know, $7,200. But still, it's still covering over 75 to 99%, which just means it's not on a one-to-one basis, which is the primo pricing. You know, DSCR loans, they still will give you a mortgage even if the rent doesn't cover the actual mortgage, but it's close. Now, outside of all this, there is still another option, right? Another option is they're just not going to check the rent at all. So say this person put 25% down. They're not even going to, see this is rent over here, they're not even going to look at this. So you say, Andrew, why don't we just do that? It sounds like a no income check program. So there's another catch to that. That's 7.5, maybe it goes up. And it's not pretty, folks. It could go up to like 8.25. Maybe depending on your credit score, could go up to even 9%. So you say, hey, why in God's name would you ever do that? It's actually a great question. So, you know, sometimes people are willing to do this only if the property, it just makes so much sense. Maybe there's a vision for it for the future. Maybe there's something that's unique about it that they're going to end up selling in the future. But there's a will, there's a way. But, you know, there are programs that have as little as no rent check, but you got to check out the interest rate, guys, because it does get a little bit spicy. So I know this is a lot. Do me a favor. Right now, guys, hop in the description, click the link. There's going to be an investor cheat sheet. It's going to give you all the stuff we talked about. Everything very clear to understand, shows you all the different options. It's free, so check out in the description. Make sure you click the link and get the investor cheat sheet. You're going to need it. But this is just a very clear, basic example of a DSCR mortgage, why it's so good. Take $1 million sale price, put 25% down, and this person had around a 780 credit score. Let's put that up here, right? So about a 780. A great investor, someone that always paid their mortgage on time, already owned 5, wanted another. Tax returns wasn't doing the trick to qualify. So in this case, originally the rent actually covered the mortgage at $6,900 mortgage. They got a great rate of 7%. Even if the rent didn't cover, even if it was a little bit less, but still close, the rate would have been 7.5, right? The 75 to 99% coverage instead of 100% or more, meaning that the rent covered the mortgage or was higher. And God forbid the rent wasn't even close. You could just do the no income check, no market rent program, which unfortunately the rate starts going up, but still, it's still a loan that someone can qualify for. If you're wondering as a real estate investor, if you're using the right mortgage type, make sure you watch our next video. Real estate investors, are you investing with the right mortgage type? It's going to go over all the different options, the full product suite. Make sure you as an investor, you're covering yourself with the best mortgage to give yourself the best opportunity to win, to get that house, to refinance your investment portfolio. Make sure you click the link and watch our next video.